So based on the conversations that I've had with the expats that live in Thailand that I know, and from reading your comments on the internet, I think I can distill everyone's greatest fear into this following statement that I have here, which is that all remittances to Thailand will be taxed according to the country's personal income tax rates. Bold statement. So in this video, we'll not only debunk that, but we'll also talk about the various strategies that you can do to minimize taxes to as little as legally possible, or in some cases, find out that you actually don't owe any taxes in Thailand. And all this is beyond my pay grade. So I have the pleasure of talking to Thomas, who is an international tax expert. So first, let's, I'll give you an opportunity to talk about your credentials, and then we'll talk about debunking that statement with the various situations in Thailand that people will have.
Yeah. Okay, my name is Thomas Carden. I'm the International Director of American International Tax Advisors. We are, I believe, about the largest international tax firm, sorry to keep repeating that, here in Thailand. We traditionally specialize in Americans who live in Thailand. Most people don't realize that as an American, you have to file a tax return wherever you go in the world, no matter how long you live outside the country. We do that, but we also do Thai taxes as well, and we do the interaction between all the other countries in Thailand as well. This is largely because you need a specialist, because you have one regime saying one thing and another tax regime saying another thing, and then you have to make sure that those two mesh. And I think what everybody's worried about right now is that those two things don't mesh. And we could talk about how this is going to work moving forward here in Thailand, and we can give an idea and help you guys plan on how those two things will mesh together, and even possibly make you more tax efficient.
Yeah, definitely. And I know like this is a very muddy and unclear situation that everyone is in, but in this video, we're going to show that there are clarities here, especially with your specialty, because you guys specialize in tax treaties between countries.
Yes.
And that is a way that you can sort out this person said this and this person said that. So we'll definitely get into that later in the video. We'll actually go by different tax treaties by country and different situations. But first of all, let's go back to that statement that I said in the beginning there. So Thomas, like, is this for real? Will all remittances to Thailand be taxed according to the country's personal income tax rates?
Okay. In a way, yes. But the reality of this is, in any type of tax code, they'll say, yes, all remittances are taxed, but then there are all of these rules and regulations that give you exemptions and ways out of taxation in this situation. Okay? You know, and the single most easiest one to deal with is less than 6 months in a day in Thailand, you can bring an unlimited amount of money into this country with us. So, and a lot of people, we're now recording this in August of 2024 with this. If somebody's coming in between now and the end of the year to move here, they can bring an unlimited amount of money in, because this is by calendar year.
By calendar year.
Yeah, this is not a 12 months.
So resets at January 1st.
Resets at January 1st. So you can spend...
So let's say you arrive today.
Yeah.
From today till December 31st of this year, you can bring provided that you were not a tax resident.
Exactly.
You just landed in Thailand.
You just landed in Thailand.
None of your remittances will be taxed.
None.
In Thailand.
None whatsoever.
Yes.
In fact, you could then spend the next 6 months, so you could go all the way through July of next year and still be in country and be free of taxation next year as well. Now, you would have to leave from July 1st to December 31st next year, or you could say, I'm going to break this. I'm only going to be here through March 31st, and then I'm going to come the next 3 months of the next year to this. As long as you're physically spending less than 6 months in the country, this really isn't an issue.
Total. It's not consecutive. It doesn't have to be consecutive.
Yes, it is total.
Total.
It's not consecutive. You can move in and out of the country. It's physical presence in the country for the count on days.
Right.
Do this.
So that immediately rules out a huge chunk of people that are here, where they don't have to pay taxes. Yeah. The next one that I would recommend people looking into is there's actually a specific visa in Thailand called the long-term resident visa that explicitly states that foreign earned income brought into Thailand is tax exempt.
That's true. And that's what happened here, and some people have doubted that's the case. But what happened here is not a law change, but it was a reinterpretation of rules. And the old rule here was that if money was kept out of the country for more than 1 year after it was earned, it becomes savings. Now that backdate continues to go farther back to effectively infinity at this particular point of holding it into the country. But if you're doing that and you're bringing that in, it kicks in and flows it nicely for you. So you can do that without any issues, to this with the LTV visa, because the LT visa is a separate law. LTR is a separate law in and of itself that states this. Because it's a rule change, the rule change does not override the law of the LTR visa.
Yes.
With it. And that's what allows the LTR visa to stand, because it doesn't, the change of the interpretation of law does not affect that.
Right. So, and this video here, we're going to focus on the taxes. It's not a time to go deep into what the LTR is and how to qualify for it. But I'll cover this in maybe the comments section or in a future video. But just know that if you get the LTR visa, which for most cases may involve a little bit of showing your assets, maybe investing a sum of money in Thailand, having health insurance, you're afforded this visa. Now, so those are two things that eliminates the need to pay taxes in Thailand.
Yes.
Another one is if your income was derived prior to December 31st, 2023, because this announcement came out, when was it? This tax announcement, it came out early.
No, it's actually September of last year.
September 2023.
2023, the initial announcement came. They said it was going to come into effect for this calendar year with it. So from this calendar year is when the reporting would be due, but the reporting would be due next year.
Right.
With it.
Yeah. But they've come out and clarified, if I'm not mistaken, that any income made prior to December 31st, 2023, if you bring it into Thailand, that doesn't apply.
The one caution on some of these statements of this is the best thing I can say on this particular one is that's the statements they've been making on this. But we're still a little bit to be confirmed, because we're still at a point in time where a lot of the regulations and rules on this have not been fully confirmed. But from what they are telling us now, anything earned prior to January 1st of this year, as long as you can show that money was in some type of account, will be free of tax.
I see. Okay.
But it is one of those things there is a slight risk of trying to plan on that particular. We'll keep you updated, on that, with a comment. But that should be the way this is.
Okay. So with this particular point here, you confirm it, but with an asterisk that it may be reinterpreted in the future.
Exactly.
Okay. Great. You also mentioned about gifting.
Yes. Okay. This is probably the largest loophole in this. Okay. But also, because it's such a large loophole, I would assume that they will change this at some point in the future. Now, but the rule stands.
Because it's as big.
It's generous.
You can drive a yacht through it.
Exactly. Okay. What this is you can gift any person who's tax resident here, who's not
tax
related
resident,
to,
or does it have to be a Thai citizen?
No,
tax resident. Okay.
10 million Thai baht, and it will not be taxable to them as a gift. Okay. To your spouse, you can gift 20 million Thai baht. Okay. Now, and we've gone through the tax authorities and asked about this very specifically with this. And you would think that me sitting here in Thailand, I would not be able to give my Thai wife 20 million baht from a foreign account.
Who's sitting right next
to me, even though it comes from a foreign account over here. The Thai revenue authorities have said that's not the case. I can gift, if it comes from a foreign account, from me directly to my Thai spouse, I can gift 20 million Thai baht.
Even if you took out your TransferWise and did it right here in front of your...
This is what they're currently saying.
That's what they're currently saying, because the money came from abroad into Thailand
as a gift.
But you need to prove that it's a gift, right?
There's no forms or regulations on this yet. Okay, but yeah, there's going to have to be some type of form. I'm assuming it'll be over 200,000 baht. There'll be a form that has to be going to show where this money came from to this. We don't have any of those forms yet in place. So that will be a compliance issue for next year, should you do it this year with it. And it's one of those things of where I would bet that somebody in the Thai Revenue Department goes, that seems counter to this, and that may change in the future.
Yeah.
But with prior announcement, and anything prior to that would be set up for this. But as the rules stand now, if you have a Thai spouse or even a Thai girlfriend, you can gift her the money. Now, that money, she can't then say, oh, here, I'm going to put that money into your Thai bank account for you. That money has to stay her. If that money's to buy a house or something like that, it has to be in the Thai spouse's or Thai girlfriend's name with this. And you can't also say, I've given a 10 million baht gift to the car dealership to buy a very expensive Mercedes and get a car back with this in it as well. It has to be a true gift to this. But in spouses, you gift money to the Thai wife.
Yeah, you support your family
and she's
anyway.
She's paying the rent and paying for the kids and stuff. That should be allowed.
Well, how about this? You gift her and she pays your bills for you. But okay.
More than likely, yes.
More than likely,
yes. As long as the bills are a joint bill.
Right.
If it's a joint bill that she's benefiting from, that should not be a problem.
Right. So let's say, I don't know, we're leasing a house. We pay 100K baht a month, right?
Exactly.
And you wire the money in as a gift, and she uses that to pay for the house.
That should be allowed.
That should be okay, right?
And one of the issues of this too it's more difficult on this because when you run in these things, you'll find a whole lot of unanswered questions. There are a lot of facts that we're going to give you here based upon the tax treaties, but this is all so new because the old rule wasn't just a loophole you could drive a yacht through, you could drive a freaking cruise ship through this. Almost nobody ever paid any income tax on international income. They just kept it in the bank account for 12 months and then brought it over. Yeah. It was just that simple. So the Thais had never really thought about all these implications of a full definition of when is a gift that person's, when it's not doing. You have to go by basic assumptions, and that gift there are things that are joint that can be used. That you do benefit off of, but she's still paying the bill because so electric bills, phone bills, cellular bills, those kinds of things. If the car is in her name, no problem, and you're driving it around, no problem at all.
What about withdrawing money from your ATM?
Okay. Right now, there are no rules and regulations preventing this and or saying you have to report this on your taxes. Okay. However, again, we're in a huge loophole.
Yeah.
There, a massive one. And there's a general terminology called structuring of where you do transactions in a particular way solely to avoid tax reporting on this. Okay. Thailand could very easily implement those laws and rules and say, this ATM card or credit card has been used in the country more than 6 months. It's just a math logarithm and plink that card off to it. They could also even, again, using common reporting standards, should they pursue somebody with a lot of money coming in for an ATM, they could go back to that country, source of the country, and find out who's done that with common reporting standard. Right now, though, that's allowed, okay, with this. However, it's something I would highly say, do not abuse that privilege with this. A small withdrawal out of the ATM, going to restaurants and all this kind of stuff is not going to cause any reporting issue with this. But don't try to structure your life around that. It will eventually, potentially, very heavily potentially, in fact, a probability more than a potential, will come back to bite people with this.
What about using your credit card?
Same scenario with this. You're gonna be. They could plink that card off. They could go back to the source if it's a common reporting standard, find out who has that card. But for now, that's allowed. Mm-hmm. But as this systems grow and mature, they're gonna look at things like this as a whole, and they're gonna start plugging it. The gift tax issue will probably get plugged at some point and say the giftor or the grantor of the gift has to be overseas at the point that that's done with it. Those types of things may occur, or the grantor of that gift may have to be not tax resident in Thailand for that year to do it, which sort of gets rid of the gift anyway. You can stay outside the country for 6 months. But as current rules go, all these things are allowed.
Okay. So I want to still address some panic and anger that I've noticed on the internet. I think it's, from my impression, it's based on people have taken for granted that Thailand's been this tax haven this entire time, with this huge loophole of income the next following year being treated as savings. Thailand, all that they're doing right now is just meeting international standards. They're just coming up to speed with the rest of the world, and people are just mad that they're now compliant with the rest of the world and no longer a tax loophole.
Most of the world on this is actually worse than this.
Yeah.
Okay, because Thailand is this at this particular point, although they said they're going to change this in the future, is moved towards just a remittance basis taxation. Okay. Now, most of the rest of the world, if you're there for 6 months in a year, you're going to report all of your global income, no matter where it is in the world, to this. And that's the case. So if I have U.S. rental property, I have to report that income and taxes paid on it and so forth. We can discuss that later on. But that's the way that most of the rest of the world is. Thailand has been this Shangri-La, and especially for Americans and Australians, this will actually continue with this, where you would be free of taxation total, with this. And we'll go through a little more on that. Sure. We'll discuss why, to this. But they're not moving to be someplace egregious in this at all. And by the way, don't let this overly scare you. There's a lot of guys on the internet who don't know what they're talking about on YouTube on this stuff, who are using scaremongering on this. For most people on this, in the end of this conversation, what we're going to talk about is that you're going to need to do a Thai tax return with this. And more than likely, you're not going to owe any Thai tax.
Yeah, the most likely, most reasonable outcome of this is that you're just going to be burdened with a tax return, but most people will find out that they don't owe anything.
Exactly.
This is just unfortunately like the state of how bureaucracy is.
Exactly.
They just love their paperwork. Okay. But in the end, you find out you don't owe anything.
Now, one side of this too is we've just gone through a recent government change here again. With this. The old administration had stated they were going to move into global taxation, which would be the way the rest of the world does this. Now, in my opinion, I'm not sure the Thais really even want to do that, but they're trying to move into become more of an OECD member country. An OECD is the Organization of Economic and Cooperation and Development. It's a big global body similar to the UN that helps formulate tax policies and economic policies and sort of equalizing them around the world with this. And I would bet you that in those conversations of Thailand trying to join that organization, they're getting pushed into more of a global tax regime with this. And that way, fewer people can try to hide money and move money around this. They have already joined what's called the Common Reporting Standard, which means if you are a UK citizen, you come here and you declare yourself here and become tax resident, they will be able to call the UK and get your income information, how much in your assets and banks, back in the UK to this. But the benefit of this is the UK citizen who may be hiding money here in Thailand the Thais will have to give that information back to the UK. So a good portion of this is the prevention of hiding money overseas with this. Thailand gets the benefit of that, and other countries do, and it homogenizes that system.
Okay.
Bank secrecy is dying a slow and agonizing death. If you're trying to hide money, you need to change your entire world and come clean, because that era is ending.
Yeah.
We as a firm will file Thai tax returns on these situations. And especially when our next subject comes up, we are the experts in this country on international tax treaties. Predominantly because as a U.S. citizen, I've had to use them regularly because of the U.S. side. We're very good at interpreting these tax treaties and all this thing. You're going to need to come to somebody like us, and there are very few of us, who can do this Thai tax return with this and minimize your Thai tax liability. You're not going to be able to go to somebody in a small town accountant who can say, I can do this. They're going to take the income and just tax you at that rate, and you're going to pay taxes. My recommendation is, we'll give you the contact information later on, is call into this. In fact, one of the things we are now starting to do is, in order to file a Thai tax return, you require a Thai tax ID number to this. The vast majority of my clients, of several thousand expats, do not have one. We're going to start on October 1st. We're shooting for a price of around 7,000 baht to go in and apply for your Thai tax ID number. This is something you can go spend a couple days in the revenue department and do for free if you want to, but you've got to deal with Thai bureaucracy and forms and stuff in this. We have a staff that we're building up to do this. We're going to start the process on October 1st, and we're going to try to get that out of the way for next year, assuming that this is going to come into place next year.
Yep.
If you want to avoid chaos or minimize it for next year, call us now, set up the appointment and get that in process. With it. I can't even guarantee that price because we're trying to go whether we can do in bulk with the Thai revenue authorities, or do I have to send an employee down one at a time with one appointment to do a tax ID number?
Yeah,
which obviously changes prices.
And we'll put your contact details in the description of this video. And then you mention my name, Jet, and you'll get a free consultation.
Exactly. So anybody who comes in through Jet's website and just says, mentions your name with it, we give a free half-hour consult, and it's not one of a sales pitch. We will actually give you answers in these things too, to your specific situation.
And again, not to fearmonger or anything, because technically you can file your taxes by yourself. You can go through thousands of pages and read these tax treaties yourself if you want. But the service that is provided here is to be looked over by a professional and give you professional advice.
One of my worries, and we'll go especially with the tax treaties on this, is that this is not really a tax issue for people, especially the first year they implement this. This was a bureaucratic nightmare.
Yes.
To this. And that's what, I have spent most of this year developing our staff to build in to be able to deal with that potential bureaucratic nightmare, because you're not going to be able to talk to anybody in the revenue authority who has any idea when this thing goes, because, the last number I heard just in Americans, there's around 125,000 Americans currently living in this country with this. Magnify that by the UK, Australians, Germans, and the French and everybody, you're probably somewhere 500,000 to 1 million expats living in this country that have never been required to file taxes. The Thai Revenue Department, and God bless them, they're trying their hardest on this.
God bless them.
This is going to be
a monumental cluster, what.
Exactly. And that's what we're preparing to do this. We're shooting, if you have an average Thai tax return, we're shooting for a cost of around $400 US. That should be what this cost you with this. But again, we don't know what hoops they're going to put us through on this.
Yeah.
We have to send somebody in one at a time, which means I'm just going to have to charge more money on this.
Sure.
But for most people, that's really what this is.
Yeah, and you're not, you don't have to be obligated to feel that you need to state a price right here, right now, because this is unfolding.
This is what we're shooting for.
Sure.
With this.
Yeah.
There's one gentleman out there who was quoting 41,000 baht for a Thai tax ID number. How do I describe it? That's a con to this. Yeah. It's more a matter of just getting the paperwork processed, having somebody sit down and do this. It's not a huge deal. Again, you can do this on your own should you choose to, but again, you're going to spend a couple of days doing this. It's for a lot of people who I've talked to have said, "Oh, we want you guys to do that, no problem."
Okay.
With it, but our job is to take that bureaucratic nightmare off of you. We handle that, and that's where our fees and services.
Okay. But now let's actually get into the meat of this video and talk about things that are actually clear, and that's the tax treaties, and that's your specialization. Yeah. And so the way I thought I would structure this, and we'll see how we can arrange this later on. I think I can attach like a PDF that's like a spreadsheet or whatever, so you can go through your nationality and your situation here. So for this video, for the purpose of not dragging this on for too long, and we can do follow-up videos based on the feedback we get, but we're just going to focus on the main countries that watch my channel. That's US, Great Britain, Australia, Canada, and Germany. And we're mostly going to cover situations for retirees. A little bit of capital gains and sales of your property, because this is a property channel, but based on my audience and based on the people that come talk to you, they are mostly of these countries and are retired. Yeah. So we're going to go through that. That's actually 15 combinations that we're going to go through here. So it's quite extensive, and I know there's more, but just contact us if you have a specific situation. You can contact Tom, and then we'll give you a real consultation.
One comment about this is high level stuff.
Okay.
Everybody's circumstances is very, very detailed. If you want advice that's going to hit your particular situation, you need to give us a call.
You can't avoid just like watching this video for free and think you can get away.
This will be this. You have to have everything down precisely, and so we're going to and the devil, especially with tax treaties, is in the details on all circumstances on this. So this is very high level. with this. We're going to give you the general concept in each of these situations, but the actual implementation of this, you need to go to somebody like us should you use a tax treaty with this.
Yeah.
But, and one of the things about this is a lot of people are saying, oh, there's no answers whatsoever on this. The one thing they have said very specifically is they're going to adhere to tax treaties. Yep. There are 67 tax treaties. Now, let me give you what the very first thing a tax treaty does. Okay.
Okay. High level definition of a tax treaty.
Okay. There are preventions against double taxation, and here's what double taxation is. Okay, I make $100,000 in a country, and I pay $30,000 of tax on that money. I now have a pool of $70,000. I bring that $70,000 into this country, and I pay, say, 30% tax again, and suddenly they tax me at $30,000 on the $70,000, which is $21,000. Suddenly I've got $49,000.
And that sucks.
And that sucks royally because now I've paid tax in the US and the tax here. The fundamental thing the double tax treaties try to prevent is exactly that from occurring. So if you are part of those 67 countries, almost every one of them will say in broad terms that if you have income in another country, say the United States, and it is brought over here, you are credited for the taxes paid in that country. So in that particular case, I've got $100,000 of income. I've paid $30,000 of tax in the US. I come over to Thailand, and Thailand says I have to report $100,000 of income, but they will credit me dollar for dollar the tax paid in the US. So I will have, in that particular situation, I will owe no income tax.
And that's, for the most part, that will be the case, because in the West, income tax rates are higher than here.
Generally, yes. Especially the Europeans, the Australians, that's generally the case. Now, one statement they have made, which I am not quite sure of how they're going to implement this, they said if income is not taxed in the country you came from with the tax treaty, it will not be taxable here.
Wow.
Yeah, that's a little bit of a...
That's another sailboat driving through again.
Exactly. It's a little bit of a thing and you can have particular issues. As an American, we have what are called Roth IRAs, where you don't pay any tax in the U.S. on that income because you paid tax in advance as far as a pension distribution. So that's not taxable in the U.S. Theoretically, under that rules, counter to what the tax treaty says, if that statement, that would be free of tax. But again, sort of one of the unknowns, unconfirmed situation yet. But what the tax treaty does say from a U.S. standpoint, we'll go through this one first. This is our area.
Okay, so we'll go through U.S. And the first scenario is you are a retired American collecting government pension. Now, this is provided that you are already a tax resident in Thailand, right?
Yeah, exactly.
If you're here less than 6 months, there's no need to even worry about this. But let's say you've been retired here for years and years and years, like my dad, and you're retired collecting a government pension from the U.S. government. Yes. So how would the tax treaty treat that?
No tax whatsoever in Thailand. Okay. Also, benefit Social Security as well, not taxable here in Thailand. Also, this is one of the biggest questions we get, believe it or not, is military disability. A lot of people live in that counts as a pension. That would not be taxable.
Will not.
Thailand. So anything that's paid by or through the federal government is not taxable here.
Okay.
Now, private pensions get to be more interesting.
Okay. So now you're a retired American collecting a private pension.
Okay.
And you can collect both.
Many Americans do.
Right.
Even government workers may have moved their TSP savings into a private pension. That would move it into the second area of this.
Okay, so let's say you're collecting a private pension. What would happen?
Now, this gets even more complex to this. Because, and this is where you really have to come to us if you're going to do this, because under the terms of the tax treaty, private pensions and annuities and other similar remuneration, Americans will know what the term means, are not taxable in the United States, but only taxable here in Thailand with this. So in that particular case, it will flip from the U.S. being not being able to tax this when we file a U.S. tax return, and then Thailand being able to tax it. But they will only tax that money on the money that comes into Thailand with this when you are tax resident in Thailand. So you can begin to shuffle. shuffle money around. You could, towards the end of the 1 year, you could take the money out, use the Thai tax treaty, and be free of U.S. tax on it. In the next year, you could bring that money into Thailand, only spend 6 months here, and be free of the distributions and buy your house. And a lot of the times on this, you're going to see this as like shuffling cards. You're using the tax treaty specifically and strategically to move money in ways that becomes most tax efficient to you.
And you guys are the master card shufflers.
This is what we plan. This is what planning does.
Yeah. Okay.
Yeah.
Great. If I'm an American collecting investment income.
Let me go through here because we actually got selling of property on this one.
Oh, we'll cover that. We'll cover that. But but about investment income.
Investment income.
Whether it's dividends, bond annuities, capital gains.
The tax is paid in the U.S. and then credited against any potential tax liability here in Thailand, which is generally less than what it is in the U.S.
Usually less, because capital gains, especially short-term capital gains in the U.S.
is regular ordinary income rates. That's definite. The other one, I believe, is 10% here for Thai capital gains. Yep. Don't quote me on that with this, but you're going to get the credit from what you pay in the U.S. against the Thai tax liability.
So for the most part, you will likely not pay taxes in Thailand because the Thai rate will likely be less than the U.S. rate you paid, and generally, you won't owe anything.
That works out.
Okay. So let's say you retire, you sell your house, and that is your nest egg that you wanted to bring to Thailand here to start a family, buy a property here with us, this channel, whatsoever. Okay, because I get this a lot because it's like, oh, Jet, well now I'm afraid to buy a condo here because for me to move that money here, I'm gonna have to prove the source of income, maybe get taxed on it.
Yeah.
So let's say that source of income was from selling a house in the U.S.
Yeah. Okay. Now for this one, I have to read my handy chart that we'll post for you.
No problem. That's a good thing that you're referring to.
Each contracting state may tax gains from the alienation of property, sale of property, in accordance with permissions of its domestic law. What that means is in the U.S. situation, tax paid in the U.S., tax credit for it back to here.
So it's similar to capital gains and investment income.
Exactly. Yeah, they'll do that, with it. Now, in the U.S., if you're selling a primary residence in the U.S., you got a $500,000 free of capital gains tax as long as you've lived in it the last 5 years. That's where the cards come into it. You say, okay, wait a second, I'm not going to move. I'm going to sell my house in the U.S. I'm not going to move to Thailand until after July 1st. You bring the money in, you buy a house here free of tax.
Meaning you bring it in before you're a tax resident.
Before you're tax resident. You can lose that tax resident the next year very easily.
I was just going to say, let's say you're already a tax resident here.
Yes.
Can you then remove yourself from being a tax resident first? Meaning leave Thailand for a year to remove yourself, sell the property, bring it in while you're no longer a tax resident.
We have people who are in this exact situation. What they have done, and some of these cases, this is several $100,000 worth of potential that they want to move into here. And this works for a Thai national as well. This is not even just a thing. They're very, very good on your losing tax residency rules in Thailand.
Yeah.
Less than 6 months in a day, you lose this. So, when it comes to I'm making $1 million on a house I had in California for 25 years, which is fairly easy to do. I bring that money over here. Oh my God, I'm going to $200,000 in tax. You don't do that. Bring it over a year. You spend less than 6 months here. Go to Bali for a couple months. Take a world cruise. Go to Europe. Do some golfing around. Yeah. Just spend less than 6 months in a day. Yeah. It really is just a matter of how you're moving money and where your cards are. Yeah. Planning makes the difference.
This is great. I'm really enjoying this so far. I hope this is making a lot of sense and giving you guys a lot of clarity so far. So we're going to move on to. Actually, the reason why I brought out my phone was I want to for the first time disclose the percentage of viewers that are on my channel. So the reason why we covered U.S. for so long is because 27.5% of my viewers in the last 90 days were from the U.S. Thanks a lot, guys. Thank you so much. And then we move on to the UK. That's 5%. 5% of my audience is from the UK. So let's go down that list again. So let's say I'm a Brit and I'm retired and collecting a government pension.
Okay, let me go through my chart here, trying to memorize all these things with this. Okay, government pensions. It states any pension paid by the contracting state or political subdivision or a local authority thereof to an individual in respective service of government nature rendered to that state or local authority shall be taxable only in that state.
Okay.
Okay, you are a government employee of the UK, only taxable in the UK with this. Nice
Done.
and clean. Yeah, so if
Done.
it's coming from the
That's
government to this. Nice and clean, easy to go. Now that, unfortunately, weirdly, that does not work for a Thai national who is a national and a resident. So for a Thai local who worked in the UK, there's one weird exception to that.
Yeah.
But a regular UK citizen who's coming here as an expat, that does work.
11% are in Thailand.
Yeah,
from my audience, but I don't know if that's.
It'd be fairly rare that they would have a government UK pension.
Yeah.
But, and this is kind of the example of this, guys. Call us and talk to us about your specific situation. It's going to be free for a half hour. If you need more time, we do it reasonable. As we value long-term relationships with our client more than a short-term charge on this.
So okay,
that's the exact kind of thing that in this you need to come talk to us, because little details can matter in this in a big way.
Great. So that settles it. What about you're a Brit, retired, collecting a private pension?
Okay. This gets. From a private pension, they don't have a lot of wording on this. Okay. They do have a statement that says salaries, wages, and other similar remuneration, which is income, paid by a resident contracting state in respect to an employment shall be taxable only in that state unless the employment is exercised in the other contracting state, which means it may be taxed in the other state. So unfortunately,
by the way, it looks like this, and then we'll attach something that looks like this as like a PDF or a spreadsheet in the description.
What this means is that if you earn wages here for work in the UK, they could potentially tax you here for them. But Thailand will only do that if they're remitted into Thailand. Okay, pensions, they don't say anything about private pensions in that. So we would have a tax situation where we mentioned earlier that the UK taxes it, and then Thailand would have the rights to tax it. But in almost every situation, the UK has taxation at a higher rate with this. But it's especially the UK, especially with their pension system, it's a real heavy issue. That's where we want to look at the solutions later on. How you move your money into one place to another can make a difference. So you can conduit that through using tax treaties, and where that money is resident makes the difference, and then you can save on this tax as well.
Okay, great. So let's say I sold my house in England and I want to bring it over.
Okay.
Bring the money over.
Such property situation. It's both. It's the same situation.
Same situation.
Yeah, UK would tax, and then it comes back to here, as well. And then any credit paid here, they'd credit the taxes paid for the UK.
Okay.
With it.
Okay. Which is usually higher there.
Which is usually higher.
Is.
Tax rates here are not onerous with this. And again, only if this money is remitted into Thailand. If the money sits out there for your beneficiaries later on, to this, none of that is taxed here.
Right.
This is literally only the money that comes into it. So what we tell a lot of people is the assumption here many, many times is this is an all or nothing situation, what all these things say. The reality of it is you can choose which money to come in. You can spend 1 year and say less than 6 months here, bring a bulk of money in, and live off of that for the next 10 years free of tax. Planning makes the difference.
So let's go with Australia, which is also tied at 5% of my audience.
Yeah. Okay.
So let's say you're tired, Aussie, collecting a government pension.
Okay. There's a little bit flip on this one, as these things tend to do. Details. Any pension paid to an individual in respect of services for the government, an employee, shall be taxable only in that state. Okay? Such pension shall, however, be taxable only in that state, in the other contract state, if the recipient is a resident or citizen of the national of that situation. So if you're an Aussie and you're here, you got a government pension, you're free. If you're a Thai who went back to Australia and came back here and you're a national and living here now, Thailand would have the rights to tax it. But you're free. The average Aussie here is a situation, and our audience here, you guys, you're free and clear on this.
Free and clear from having to pay taxes
on government pension.
On government pension in Thailand.
In Thailand. Good, because everyone has a super in Australia, the private pension to this, and very, very good news. Private pension, their superannuitization is a term they use. I got to work in Australia and New Zealand for 5 years, so I'm very familiar.
Excellent.
We actually have an Australian tax expert on staff as well.
Ah, nice.
With this. pensions and annuities paid to a resident in one of the contracting states shall be taxable only in that state. Okay, means pensions and annuities paid to a resident of the contracting state shall be taxable only in that state. Yeah, this means that private pensions, superannuitization would be taxable only in here, but get this.
Only here.
Not taxable in Australia.
Not taxable in Australia.
And Australia has higher tax rates.
Okay.
So now you can do the same thing on this in Australia. You could say, wait a second, I'm getting all this money out of my pension system in Australia. I'm resident in Thailand now. Do this. Okay.
So you can avoid the taxation
you can avoid
in
Australia
and pay the lesser rate in Thailand.
It doesn't say the money, no, it doesn't say the money has to be remitted into Thailand.
Oh.
So you can move that money into, say, Hong Kong.
And don't get taxed at all.
And bring it into and not be taxed at all.
And not be taxed at all.
By proper planning.
By proper planning. You can potentially pay nothing at all.
You can wipe out the taxation.
Not even in Australia, not even in Thailand.
Exactly. Here.
Okay.
Using that particular thing, you can say free of tax there.
Okay.
Now we'll go through a sale of residence as well.
So Aussie who sold a house.
Income or derived a resident contract state from selling real property situated in the contract state may be taxed in that other state. Okay, so you sell property in Australia and you bring the money into here, it's not taxable here, it's only taxable in Australia for your house. And again, they have very large gains in their property, so that money can be remitted in carte blanche. So say you got somebody who decided, I'm going to move here. I've sold my house in Australia for a $500,000 profit, and I'm going to take a pension distribution, private pension distribution of $1 million Australian dollars. You will pay tax on that $500,000 in Australia, but you won't pay tax on the $1 million pension distribution should it be taxable. Some are and some aren't in Australia. But you can bring in to here that sale of that house proceeds free of tax and keep the money offshore for as long as you want to, or move that into a foreign pension that has tax benefits, and then bring that onto it later on with this. Mm-hmm. Again, shuffle your cards.
There is a way.
Shuffle your cards.
Yes.
Planning makes the difference.
Okay, great. Canada. So I'm retired Canadian collecting a government pension.
Okay, government pensions again, and other superannuation where they consist of periodic or non-periodic payments for past employment arising in a contracting state paid to a resident in the contracting state shall be taxable only in that first mentioned state. So Canadian pensions are only taxable in Canada, government pensions.
Canadian government pensions.
Government pensions
only taxed in Canada.
This tends to be one of the cases with this, that most treaties, and total generality here, if you are a government pension, it generally stays taxable where it arises, only in that situation. Where it gets more complex is private pensions. Okay.
Canadian private pensions.
Private pensions and other similar remuneration, whether they consist of periodic or non-periodic payments for past employment, arising in a contracting state and paid to a resident of the other contracting state shall be taxable only in that first mentioned state. That matches the government pensions. Guys,
so
Canadians,
pensions.
You have no tax issues on pensions.
On pensions.
Okay. Here in Thailand.
Wow.
You're still dealing with Canadian taxes. Unfortunately, they're higher. Those particular guys, they'd probably prefer it be here with this. No offense, guys. But you're from a tax standpoint, you're free and clear. Now, one thing about this too, okay, you're going to have to declare all this income using tax treaties with this. While you may be free of tax here in Thailand on it, you're still going to have to tell Thailand this. You're still going to have to use the tax tree and file this tax return for it. Again, bureaucratic nightmare rather than an actual tax nightmare.
Okay.
So these guys are going to be in the same situation. Even though these aren't taxable here, you can't just go sit back and go, I don't have to file a tax return. It's not taxable. No, they're going to demand that you file this return and report.
And you usually have to do the same thing in your home country, even though you're a tax resident in Thailand now.
They're going to, especially if we're using the tax credit situation.
Yes.
They're going to want you to prove through some type of document that you've paid that tax and or accrued that tax liability in that foreign country.
I see.
So, this is going to be, the timing in each of these countries is going to be different on when you're reporting the income you're reporting, because different countries will have different split years. They may end up in July of the year and their tax reporting is for 2 different years. Part of the conflicting power of this is when you pay taxes and how you pay taxes and all of this. And I mean, pretty much any money you bring into this country, you're 6 months in a day, you're going to have to file a tax return. Even to an LTR visa, I would bet you're still going to have to file a tax return and state, I'm on an LTR visa. I don't have to pay tax.
Right, but you still need to submit
still,
that document.
The assumption with an LTR visa is that, but right now that's what they're telling us.
Okay. So if you sold your house in Canada,
situated in other countries, I mean, taxed in that other. Okay, gains derived. This is the same situation of the money moving from one to another. So it's a tax credit. Gains derived by a resident in a contracting state from sale of property shall be taxable. It may be taxed in another contracting state. So that's a tax credit situation. But again, higher tax rates in Canada. So you do sell your house, you want to move that money into here, you're more than likely going to be free of tax, but you got to file a more complex tax return.
Okay.
With it.
All right. So we have our Germans. That's another top 5 audience in my channel. So let's say you're retired German collecting a government pension.
Okay. Pensions and other payments for past employment, as well as annuities paid by or out of funds created by a contracting state, a land, a political subdivision, local administration thereof, shall be exempt from tax in that other state. Same situation. You're a government employee, you are free of tax, German tax here in Thailand, German income. Germany taxes, Thailand does not. Private pensions. Pensions and other payments for past employment, as well as annuities derived by a resident of a contracting state, may be taxed in other contracting state only if such payments are deducted as expenses in the profits of the enterprise or other state or a permanent establishment situation therein. This is clear as mud. What this means is the only way your German pension would be taxable here
private pension.
German private is if you were working for a German company here and that pension was paid, it was literally deducted off as an expense for them. I would think this was very, very rare.
So otherwise, you're in the
German
clear.
private pensions, you are in the clear.
Okay.
With it.
You sold a German house.
Sold a German house. Same situation. Maybe taxed in the contracting state which the property is situated. With it. It does not say only, so that would be a tax treaty.
Okay.
This is more than likely for the majority of the viewers you have, not really a tax issue.
No.
Because one way or another, these agreements are set up to try to get you to paying the one rate or another to this, and so it becomes a bit of a bureaucratic nightmare to do this, which is what our firm does. This is what we try to do, and we try to help people out from winding through this.
Yeah.
And how do I have set up a conversation with us through the end of this year for the free half hour, and that may help you eliminate more chaos later.
Yes,
on.
I mean,
I'm not even sure that we're going to have capacity above several thousand people doing this. At some point, next year I may have to say, if you haven't contacted us and signed up,
you're gonna have to expand.
We're trying to desperately.
Yeah, you need a bigger boat.
Yeah. To it. But,
symbolic of the loopholes you're driving through. But I mean, the purpose of this video is not to give you a definitive legal answer because that's just impossible to cover every nuance. Yeah. It's just to give you reassurance that there are concrete tax treaties in place that you can utilize to optimize your tax situation so you can pay either minimal or no taxes at all. Like that the fears that I stated in the beginning that all remittances will be taxed no matter what according to Thailand's personal income tax rate that's just not the case. Period. Now, this was amazing. And you mentioned a few times about the Hong Kong pension fund, and that's something you help structure as well. Can you just get into that?
This is not for the faint of heart. It's all out to this. And you end up with multiple tax treaties, which the contracts and all this have to be very specific.
Yes.
But we do work with a couple firms in Hong Kong, because again, one of my goals to set this company up many years ago was to put this high level planning that very wealthy people were able to do and bring this more to the mass. So we tend to be very reasonably fees. We want to have you as a client for 10 or 20 years rather than an instant thing on this. But one of the things we do a lot of people who are business people. We've got relationship with Hong Kong pensions already. We can refer you to these people who manage these. The one of them, Soteria, has an office here, has officers who we can set you up with, talk to, and how to discuss this. But one of the things to do this, because again, this is a remittance basis issue. Now, right now, if you can take money out of any other country you can put that into their pension plan
In Hong Kong.
in Hong Kong, and at certain points you can bring that money forward. You can actually take loans against it too very quickly, and bring the money here into Thailand. Okay, what this allows you to do, if structured properly, see a professional with this, folks. It would allow you to take the money that is taxable here, move it into there, and to begin to live off of that money for effectively the rest of your life, or until they change that tax treaty. And those things rarely get changed with it. But that type of pension is very specifically listed of a retirement account for this is listed under the Hong Kong Thailand tax treaty as not being taxable here in Hong Kong. And under Hong Kong tax rules, it's free of tax. Now, a lot of people are like, oh my God, what happens if China moves in on Hong Kong? That's not an issue with this. You can have US stocks, you can have UK stocks. You can invest in virtually anywhere in the world. The contract pension that's in Hong Kong is effectively that. It's a wrapper that goes around your investments. So they don't have to be held in a Hong Kong bank. They don't have to be a Hong Kong listed stock. Those assets are just held for you effectively in trust through that pension. If, God forbid, the government were to change in a bad way, any financial institution around the world is going to realize that you are the end beneficiary. You can dissolve that pension and move those assets into your IDLE. Mm-hmm. Don't fear that I'm saying Hong Kong and China in this. It's literally just using that particular contractual wrapper to hold your assets, which is the basis of any pension. Any pension is holding an amount of money for you in that account. It's just, where it happens to be located in their headquarters.
And the high-level purpose of setting up this structure is in cases where you would have otherwise paid taxes if you had held it in this structure here.
You will minimize your tax dramatically. Yeah, to this. And this
applies to Americans, Brits, Aussies.
Yeah, anybody who wants to bring money into here, because most people, Americans are very unusual in that when you are taxed no matter how long you're outside the country on your assets until you literally renounce your citizenship. We do that. For people, you have to file 5 years of tax returns. But for everybody else, if you're outside of that country and your assets are outside of that country, you're going to lose tax residency to this. You can do this in the UK, you can do this in Australia. Although they're cracking down in Australia now to lose tax residency, you have to have a tax ID. You have to be tax resident in another country. That was a change that came down this year as well. So if that money is no longer sitting in Australia and you are not tax resident in Australia, and you are here and that money's not going to be taxed here by a tax treaty, this is a very, very clean way to organize your affairs. And here's one of the great things about this too. I am lucky to have a Thai wife. My wife, though, is very, very sophisticated. She has a US master's degree, a UK master's degree, and a Thai law degree as well. I don't worry about her economic sophistication. But a lot of gentlemen will come here and marry a Thai woman who may not have that level of sophistication. And what happens if she gets $500,000 or $1 million or $2 million? Generally, the families can come in and start pulling that money up bit by bit. And unfortunately, that woman is broke in a couple years with this.
Happens all the time.
And unfortunately, you cannot set this up in Thailand where there's a trust for her for this income to go into, because trust law does not exist here in Thailand. One of the weird quirks of the place. But with these pensions, you can put this money into there and allow this to not even go you can set this up to where she gets a lifetime income. In case of emergency, she's able to pull the money. Again, free of tax because this is a pension program. But you can also sit there and say, oh yeah, I do want my kids back into Australia to get some of this money as well. And the money will flow back to them as well. And so, in the US, we always get the issue too of estate planning, of like, hey, my grandkid's going to get this money, but he's 19. He's going to get $900,000. What's going to happen? Blah, blah, blah. Well, invariably he gets married at 24 because he's got a lot of cash right now. And the wife walks out 5 years later, takes half his assets. These things are also unattachable in cases of divorce, in all these situations. That kid's
unattachable.
Unattachable. Those kids are going to get that money on an annual basis for the rest of their life. Just a secondary benefit of this proper planning.
Yeah, Thomas, this was outstanding.
Thank you.
I learned so much. This was amazing, and You can contact Thomas and his firm. I'll link to them in the video description. Mention my name and you'll get a free consultation. Let me shake your hand, man. That was amazing. That was the most satisfying video on this topic that I've seen so far. Not to toot my own horn, but that's mostly you.
Yeah, I mean, when we actually met about this and we talked about this, and Jet was very specific. He didn't want hyperbole on this.
No,
in what you do. You want facts, and a lot of these guys will be trying to terrorize you to keep viewers on this stuff. You don't really have to be. And I will say there are a lot of unknowns of the forms that are going to be used in this kind of stuff, which again, come in early with this, guys, because we may hit capacity next year where I've got to say, I can't do any more people to this.
For sure.
Come in, sign up early with this. We'll work with you and get you in line on this thing. One thing I will say, if you are living here currently, either go in now and get a tax ID number or contact us fairly soon, as soon as possible.
Yeah.
Get that part of the bureaucracy away, because if they fully do this next year, that 1 or 2 days goes to weeks of sitting in the office just hoping you get that appointment to get that tax ID.
Oh yeah.
To it. It's better to get that done this year. If they push this off by another year for reporting, you don't have to do anything. No big deal. You've got that tax ID number. It stays with you.
Great. Depending on the feedback we get on this video, we may do follow-ups based on where the sentiment goes and all like that. But for now, we're going to end it here. Thank you so much for being on here, and hope that was useful information to you.